In the world of sportswear, 2025 wasn't just another year, it was a crucible, a period of intense pressure that basically split the industry right down the middle, creating a stark divide between the winners and the losers. We've dug through the financial reports, and the data shows a fundamental reshaping of the entire market, so let's break it down.
And this quote from Adidas, it really sets the stage perfectly. This wasn't about one company making a bad move or a single misstep. The entire industry was navigating a storm of global volatility. This was the universal backdrop that every single brand was performing against.
So here's how we're going to walk through this pivotal year. First, we'll cover the industry-wide stress test. Then, we'll explore what we're calling the great divergence that it created. After that, we'll dig into some of the hidden risks we found in the financial data. And we'll wrap up with the strategic playbook that's going to define the next decade, building a technology moat.
Okay, first up, the stress test. Let's look at the common challenges that hit every single company, from the absolute giants of the industry all the way to the up-and-comers.
You know, when you look at the annual reports from every major player, Nike, Puma, you name it, they all paint the exact same picture. The gauntlet of 2025 was just relentless. You had global trade disruptions and shifting tariffs squeezing margins. You had consumers being a lot more cautious with their spending. And all of this was happening in a hyper-promotional market with fractured supply chains. It was truly a perfect storm of challenges.
Now here's the crucial takeaway. While everyone was facing the same storm, not everyone had the same ship. The different strategic responses to all these pressures are what created this massive divergence in performance. This is where things get really interesting. Let's look at the numbers.
And you don't have to look any further than the industry titan itself, Nike. A staggering $5.1 billion drop in revenue from one year to the next. Now, this wasn't just a small dip. This was a loud and clear signal that even the most dominant players were absolutely not immune to the forces at play.
But at the exact same time, check out this contrast. While Nike was shrinking, Amer Sports saw absolutely explosive growth in a key segment, a more than 62% surge in its outdoor performance direct-to-consumer revenue. This right here is the great divergence in a nutshell. Two companies, same market, heading in completely opposite directions.
So, how did this happen? Well, we're seeing two dominant strategies emerge. On one side, you have the multi-brand portfolio approach, which companies like Anta and its subsidiary Amer Sports have perfected. Their playbook is to acquire a diverse roster of brands and then use a centralized platform to scale all of them. But on the other side, you've got the focused brand power of a Nike or a Lululemon, who pour all of their resources into cultivating one single iconic brand identity.
And this split in strategy leads directly to a split in who they sell to. This slide shows that contrast perfectly. On one hand, you have a brand like 361 Degrees, which is aiming right for the high-value mass market, performance for everyone. On the other hand, you see Arc'teryx, a crown jewel in the Amer Sports portfolio, which has built an empire on its uncompromising premium position. These aren't just different products, we're talking about entirely different philosophies on how to win a customer.
And this divergence, it can even happen inside a single company. Take a look at Wolverine Worldwide. Their running brand, Saucony, surged by over $126 million. Merrell also saw some really solid growth. But another brand in the very same active group, Sweaty Betty, saw its revenue decline. It just shows that even under one roof, the right brand strategy matters immensely.
Now let's go beyond those headline numbers of growth and decline, because the 2025 reports revealed some pretty significant risks just bubbling beneath the surface. Let's take a closer look.
This chart from Puma is absolutely stunning. The company took a massive operational loss of over €500 million. They called 2025 a reset year, which was a deliberate move to clean house and restructure. But wow, what a stark visual reminder of the financial pain some brands had to endure just to set a new course for the future.
So this leads to a critical question. Beyond how any individual company performed, what's the one risk that appeared in some form in almost every single financial report we analyzed?
The answer is the fragility of the geopolitical supply chain. It's this whole complex web of risks. You have legislation like the Uyghur Forced Labor Prevention Act that creates huge compliance hurdles. The U.S. eliminated de minimis exemptions, which basically drove up costs on direct-to-consumer shipments. And, as Lululemon's report highlights, there's the looming threat of regional instability in key sourcing areas like Taiwan, which is a hub for technical fabrics. This isn't just a line item in a report, it's a fundamental threat to how these companies operate.
So, in a landscape that's defined by stress, divergence, and risk,
how do the winners plan to secure their future? Well, the answer lies in building a defensible advantage, what we're calling a technology moat.
So what is a technology moat? Well, think of it as a brand's competitive defense. But instead of castles and water, it's built with relentless innovation and R&D, with scalable operating platforms, and, maybe most importantly, with direct channels to gather data from and build relationships with consumers.
The winning playbook that's emerging from the top performers is really a three-step strategy. It starts with deep investment in R&D. It's followed by building a scalable operational platform. And it all culminates in mastering the direct-to-consumer channel.
For step 1, just look at 361 Degrees. Their stated core strategy is technology-based, brand first. They are putting technological innovation and product performance at the absolute center of their identity. This is not an afterthought for them. It is the foundation of their entire business.
For step 2, Amerisports provides the perfect model. Their strategy is explicit. Use their central platform to scale all of their brands, from Arc'teryx to Salomon to Wilson. This creates massive efficiencies, and it allows each brand to tap into shared infrastructure, data, and supply chain expertise.
And finally, mastering DTC. The results from Amerisports are just staggering. We're seeing massive direct-to-consumer growth across all their segments, from technical apparel to outdoor performance. And this isn't just about sales. It's about building a direct relationship with the consumer, which creates this powerful flywheel of growth and gives them invaluable data.
This all leads to one final fascinating question for the industry. As these multi-brand platforms like Anta and Amerisports continue to scale and acquire, who truly holds the power? For consumers and for investors, the question becomes, do you bet on the individual iconic brands or on the powerful brand owners who operate the platforms they all live on? That is the battle that's going to define the next decade in sportswear.